It's live.
Ooh. Hey, it's Person Empowerment Money Monday, and it is the conversation that helps you convert into some more cash. All right. So let me grab my money, honey. This week we are talking about how to use your credit to build a wealth. So just come on in, and as you guys come in, I'm going to make sure that you got some money, honey. I'm going to make sure that if you're tuning in, that you at least get one thing that's going to add some value to your purse. So I'm going to share it with you, okay? So open up your spiritual purse, your actual purse, your bank account. If you still got some of your stimulus check, let me go ahead and just multiply some of that for you. You ready? Here we go. All right. I hope that this week money flows to you easily and effortlessly. And when it comes to you, you know exactly what to do with it. All right. So we're going to get right into this show. The first thing I'm going to start with a few simple little stats, just some simple little stats for you. So you guys just have an idea for what is going on the larger scale when it comes to money, simply because there's always this very interesting conversation that kind of cycles around on social media about, would you rather have X amount of dollars? Let's just say, if we're going to say $500,000 liquid, meaning cash, liquidity. It's not tied to any investments. It's just liquid. You can put your hands on it, right? Or would you rather have an 850 credit score? All right. So if you actually have an opinion about that, drop that in the comment section. Would you rather have $500 liquid, or would you rather have an 850 credit score? Okay. Obviously, I'm going to share my opinion closer to the end of the episode, but I'd love to hear you weigh into the conversation as we get going. Okay. Let's go ahead and look at some of those credit stats really quickly, just so that we can get an idea for the credit climate in which we live in. Okay. So let's start with that first stat, Natasha. Let's see it up here. Here it is. So 5 reasons to improve your credit score. Some very interesting things. I'm going to move over to that first one. It's very, very interesting. All right. So the first one, Natasha, it didn't show anything. It didn't show a stat. So run it back for me, because it didn't show a stat. There we go. So interesting enough. So the first reason is one in 7 job applicants don't receive offers due to poor credit, right? So that still has an impact on your ability to get a job or not get a job. Okay. The next stat. Let's see that next stat. We can just keep running those stats really quickly. Show me the next one. Show me reason number 2. Alrighty, so those with a credit score under 680 pay 1 to 2% or higher on their mortgage loan. So if you're in the market to purchase a property, then you're definitely going to pay a little bit more for it, simply because your credit score is not up to par. Show me another stat, Natasha. All right, 42% of adults say knowing someone's credit score, that's 42% of adults say knowing someone's credit score would affect their willingness to date that person, right? So actually it can have an impact, because maybe if someone is looking into a partnership, they want someone that they can build with, someone that they can buy investments with, someone that they can buy property with, okay? 1 out of 3 Americans have a credit score that is below 600. So I know on social media, everybody looks like they are getting to the bag, right? But that stat just showed us that a lot of us have credit scores that's under a 600. And only about 20%, right, of Americans have a credit score of 800 or above. So that means that there's 80% of us that is not in the 800 club, sis. Okay, so I know sometimes people are like, Shawnee, you talk about credit. Yes, sis, the stats say that I should keep this conversation going. So that is exactly what I'm going to do. Okay. So I'm going to go through a few of my questions. Hey, Zinzale. So I'm going to go through a few of my questions that I received this week. Okay. I'm actually holding them inside of my book, 10 Things Every Woman Should Keep in Her Purse. I'm going to drop that in the comment section if you haven't read my book as of yet, 10 Things Every Woman Should Keep in Her Purse. It's a really great guide for helping you understand your credit, how to eliminate debt, and how to get a hold of your emotions. So I'm going to drop that in the comment section for you if you want to grab yourself a copy of this book, 10 Things Every Woman Should Keep in Her Purse. Okay. So a few questions that I received. So one of them is people wanted to ask me, why should I be building my credit in the first place, right? Okay, Zinzi, you're saying you'll take both. You'll take both. Hey, Naomi. Okay, so I'm just going to tackle some of those questions. For those of you that are just joining the conversation, be sure to drop them in the comment section, because I like circular conversations as opposed to just giving you a whole bunch of information. I like circles. I like community. Okay, see my B? Can you see my B? Yes, the B is all about community, and so am I. Okay. Alrighty, so one of the first questions that I got here is, it was very interesting. I got this one on Instagram, and they were asking me, why is it so important to even boost your credit score in the first place? They just really couldn't necessarily see the perspective to it. And it actually goes a little bit to my answer when people are saying, would you rather have $500 liquid, or would you rather have an 850 credit score? So interesting enough, I work with lots of entrepreneurs, both females and males, right? And what's so interesting is that I see them kind of stagnate in terms of their ability to scale and their ability to grow their businesses, right? Simply because they don't have access to cash in order to grow, right? So they may stay at that same, there's a very interesting space for entrepreneurs. Sometimes they can exist as a corporation, as a qualified bona fide business, right? And then sometimes, depending on how they organize the business, then sometimes it can really feel just like they just gave themselves a job, right? That's the ones that you don't like. These are the ones that need tighter systems, and they actually need access to more credit so that they can begin to scale, so that they can scale their marketing, so that they can scale the people that's on their team, so they can scale, their ability to compensate themselves, right? So they should be able to scale those things. Also, if I'm not talking to those that are entrepreneur, then there's a challenge when, say, for instance, if you're saying you want to purchase a home. Well, if you want to purchase a home, I'm all for saving, and I'm all for people eliminating debt. One of the greatest things that I've had the opportunity to do is pay off a mortgage before I turned 40. So that's something that I'm always really excited about. I'm always excited to see people get out of debt and not have it over them, especially because that made it very easy for my entrepreneur phase, because I didn't have that debt hovering over to my head thinking, okay, I got to pay my mortgage, The fact that that wasn't there, it made it very easy. So I do support and I advocate that. However, the property that was purchased at that particular time was for $80,000, right? So to be able to come up with a hard money loan in order to actually get the property was one thing, right? So that was a whole different thing, but it wasn't $500,000, right? So whether you're going to work yourself, 20, 10 years, 5 years, whatever the case may be, just to get, $500,000 to purchase a house, it really just doesn't really sound like a good uses of time, right? It just doesn't sound like a good use of time. So for me, I'm going to go with both, just like you, Zinsley. I'm going to go with both. I'm going to say that it's incredibly important to be able to build your credit as well as be able to build your bank. And in a lot of cases, when you weren't necessarily born into money, it's actually a prerequisite to be able to build your credit before you can begin to build that bag up as strong as you would like for it to be. So I'm a bother on that one. Okay. So that kind of answers the question when the person was like, why would I build my credit score in the first place? Just because you want to grow and you want to expand, right? Let's say if you want to get a job, right? If you want to get a job and you have to go to work, right? Or let's say, you want to get a car or something like that. Are you going to wait until you can save up $3,000, $4,000, $5,000, $10,000, $15,000 and let that be the space between you getting? Oftentimes my clients complain about they complain about their student loans, but oftentimes what I have to put in the next step is that, hey, you're a doctor, you're a nurse, you're a pharmacist, right? Was there 60, 70, 80, 90, $100,000 in money sitting aside for you to be able to educate yourself? Or was it a necessity for you to have access to some level of credit being extended to you in the form of a loan, right? Do I always like the interest rates attached to student loans? No. Do I like that it's calculated daily? No. Do I think that they should have done something more aggressive about student loans? Yes. Am I hoping and praying that they do? Yes. However, in the interim, as we make ourselves onto that path, I'm going to say that you want to put yourself in the position to always have access to other people's money, right? And also when you have liquid, the power of liquid gives you the opportunity to be able to invest, right? So if all of your liquid is tied up, right, in a particular asset, be a car, be it a house, then that means that you have limited ability to kind of really move around as fast as you would like. So I like to see people, not with one or the other. I like to see you in that boat, with both sides, rowing and rowing, rowing that credit and rowing that cash and that liquidity. Okay. So that's going to take care of my answer. That's the number one. My number one reason to build your credit is to make sure that you can have access to other people's money. Whether you need access to other people's money to buy a car, whether you need it to get a home, whether you're trying to make an investment, whether you need a business loan, I want you to always be in the position to always have access to not just your money, but some OPP, sis and sir. All righty. Moving on to the next question. Oh, Shani, why is it that I should not use Credit Karma? Okay, so interesting about Credit Karma is that it is really good when it comes to just knowing if something came on your credit or if it's moving off. I don't have an issue with it. When my clients have Credit Karma and they're just necessarily just using it as kind of like a very soft identity protection, right? Whereas when something happens, there a change on their credit report, Credit Karma is going to let them know, okay? But however, if you are looking to purchase a home, or you're listening to purchase a car, I'm gonna say home because I was merging those two thoughts together. So if you're looking to purchase a home or you're looking to purchase a car, right? What they're looking at is your FICO score, right? They want to see your FICO score, right? Credit Karma holds on to what's called your Vantage score. So there's two different things between a Vantage score and your FICO score. So if you are in the position or you're positioning yourself to either buy a car, to buy a home, to get a loan, you probably don't want to be using Credit Karma just because it is a Vantage score. Also, it only has two of the bureaus. It only has TransUnion and Experian, right? So sometimes if you're working on your credit and you're only able to see those two credit bureaus, that means that there is one credit bureau that you don't have access to. You don't know if your collections are on all of those bureaus. You don't know whether or not if there's an error on all of the bureaus because you're only looking at two. So that's two reasons. Thirdly, if you're looking to dispute or remove anything, the thing about Credit Karma is they don't have any account numbers. So if you're going to be disputing and you want to get things removed and you've lost tracks of your documents, you don't know where they are, Credit Karma isn't the best resource for that in terms of having account numbers if you decide that you want to dispute an account or not. However, if you like Credit Karma because it's free and it gives you that little bit of soft identity protection, then definitely go for it. Okay. All righty. So we got another credit question. Someone's asking me, what is one of the first things you should do if you're trying to repair your credit? Okay. So the first thing that you should do if you want to repair your credit is you definitely don't want to have any more late payments. Late payments will drop your credit score anywhere from 25 to 50 points, depending on the type of debt that it is. So clearly, if it's your credit card versus your car, obviously you're going to be higher to that 50 than you are to that 25, simply because if you late on your car, sis, they probably like, she liable to do anything, right? So they're going to ding you for that. What they're looking at in terms of that is they're looking at your credibility. So always think about that. I know that we shorten that word and we just call it credit, right? We just say credit score, but really the longer extension of that word is credibility. And when you think about credibility, it is your ability to borrow money and pay it back. So the way that you demonstrate that is by borrowing money and paying it back. Yes? Yes. Okay. So the number one thing that you would end is definitely making sure that you do not have any more late payments after today. If you had some before, you're not going to have any more, right? Not anymore. The other thing that you would want to do to make sure that you don't have any of those late payments, just go ahead and put everything on auto pay. Set it and forget it. I don't like set it and forget it when it comes to your insurance. I don't like set it and forget it when it comes to your investments, but I do like set it and forget it when it comes to paying your bills on the minimum, right? And if you are in larger debt, then you should be making two payments or maybe multiple payments within a month, but that minimum payment is always going to be in place. Sometimes I look at my clients' credit scores and I'm thinking, oh my gosh, your credit has went down for a $25 payment, and I know you have $25. It might have been, busy. You might have been, handling a lot of things. You might have just had a whole lot of things going on. Next thing you know, you have a late payment, drops your score 25 to 50 points. But if you put it on auto payment, no matter what's going on in your world, that $25 is coming out. All right. Okay. So we're looking for some resources in order to rebuild your credit. Okay, so we got a question about rebuilding. All right, so rebuilding your credit, one of the first things that they're looking to see is that principle, right? That very governing principle when it comes to credit, your ability to borrow money and pay it back, right? So oftentimes people will say, well, Shawnee, I can't get someone to give me my first credit card, my second credit card, my third credit card. I can't get them to do this. I keep getting denied. I keep getting denied. I keep getting denied. One of the ways to do it, if you're seeing where no one else will give you credit, you give yourself some credit. Yes, sis, you give yourself some credit, right? Just like sometimes you got to compliment your own self. That's what you got to do with your credit. You got to give yourself some credit, okay? Giving yourself some credit is through a secured card, right? And what happens when you create this relationship, you go to your bank and you have to make sure when you're dealing with the institution that they're going to report this secured card to all 3 credit bureaus, okay? Because oftentimes I work with my clients and they got a secured card, but they do not report it to the bureaus. And sometimes when they report it to the credit bureaus, they don't report it to all 3 credit bureaus. But you want to make sure that if you go to your bank and you say, hey, I'd like to give you $500, and minimally, I like to see my client started with $500 all the way up to $2,500. The reason why I advocate for more like the $2,500 is because when they see that you give yourself some credit, that means that you trust yourself with some money. And you know what happens when you begin to build trust with the credit bureaus is that they want to give you more money. So the higher your secured card is, the more it looks like you can handle. So if you start at the 500, I always advocate for my clients, okay, in 3 months, do another 500, or go back into that institution and say, hey, can I go ahead and increase it, right? So maybe I was at 500, now I'm at 1,500, 2,500, and it looks like I have the ability to be able to borrow money and pay it back, okay? Some of the other ways, because I even have in some cases where my client's credit is so predatory that they can't even get a secured card. Then there are some other options for you. You can use Credit Strong. I'll drop that link inside of the comment section. You can use Credit Strong. Credit Strong will allow you to incrementally create a secured card. Essentially, it's a secured card that's actually a savings account that's not being able to use it, right? You can't use it the way that you can use a secured card, but it will report on your credit, okay? So those are some other ways that you can be able to build credit if you try to get a secured card and they won't give it to you. But typically, after using 1 or 2 of those methods, some of my clients have to use both of those methods, create a secured card, as well as use Credit Strong so that they can begin to build their credit incrementally. Then they can, within that 3rd month that they've tried this, okay, now they've built up some credibility credit. Now they go back in and they apply for a regular credit card. And once you get that regular credit card, this works for both, right? This works for both. Once you get that regular credit card, you can, you want to make sure that you do not, I'm thinking 2 thoughts. You want to make sure that you do not go over that 30% utilization, okay? Because think about it like this. If I come to your house and you say, hey, Shawnee, welcome, you know, you can have dinner here or whatever, and it's great and we're having a good time, right? And then I eat, right? But then I pack up a plate, sis. I pack up a plate for my sons, and then I pack up one for my sister, and then I'll be like, you know what, this is so good, I might as well take one for my mother, right? And you like, dang, sis, I mean, you're welcome and everything, but you're taking way too much. Think of your utilization in that way, right? When you're using your credit cards, right, and they're extending credit to you, and you're just using it and using it and using it, especially once you hit over that 30%, what it looks like to them is you don't have no money, sis. And who wants to give money to somebody who ain't got none? You heard, okay? So think about your utilization in that regard. Like, I'm not going to be greedy. I'm not going to take more than I can spend. I'm not going to bite more off than I can chew, because the credit bureau is looking at my ability to borrow money and pay it back on time by design. Well, I've answered all of my questions. I'm gonna head over to IG just because some of the questions. So with great credit, Naomi's coming. So with great credit, do you think you should put 20% down on a home? So Naomi, that actually has a few, that's a little bit of a loaded question. So I'm gonna do the best that I can to really unload it. And you stay here with me in the comment section and make sure that I actually answered it, okay? To the best of my ability. Okay, so that 20% that you're going to maybe being asked to put down by way of a conventional loan is really going to dictate the type of home that you have access to, right? It's also going to dictate, you know, the type of home, because sometimes if you're using a FHA loan and you're putting down lower, maybe 3.5%, then there's some homes that you don't have access to because maybe it needs way more repairs. So sometimes people don't like to use FHA because they want to get a home that has way more repairs, but because FHA FHA is backing that loan, it's backed by government funds, they're going to be a little bit more selective about the type of property that you have access to. Okay, so that is one of the ways that will dictate whether or not if you're going to be in that 3.5% or if you're going to move over to that 15 to 20% with a conventional loan, therefore giving you a little bit more flexibility with the type of home that you get. It's not putting the amount of money that you put down is not always subject to your credit. It's also oftentimes attached to the type of property that you're interested in. Okay, so that's the first tier to answer your question. The other part of that question is, are you trying to get rid of your PMI, right? Because what happens is when you put down less than that 20%, then you're going to have that property mortgage insurance. And a lot of times people like to put down that 20% right off the bat so that they can eliminate that and they don't have to pay that PMI over the life of the loan or till they refinance it or until they have more equity in the property to get the value reassessed in it. I know that was a little loaded. So there's a few different reasons why people choose to put down more money. Oftentimes with investors, with an investor, or they don't like to put as 20% down. They don't always want to put that 20% down because it's not a property that they're going to hold. So they don't want to put so much liquid into that particular property. So it really depends on the purpose that you're purchasing the property for and the type of property that you're purchasing the property for. Is this a property that you're going to stay in for 15, 20, 30 years? Or is this a property that you're going to unload within the next 5 to 10? All of that is going to have an impact on how much cash you come out of. Now, there are some cases where, based on your credit score, you will have to come up with a little bit more in terms of down payment. So hopefully, Naomi, you let me know if that answered the question for you. Yes? Okay, we got another question. Could you move like you had 500 grand if you didn't with a 850 credit score? Can you move like you had 500 grand if you had an 850 credit score? Really depends, right? Because sometimes I have clients that have an 850 credit score and they're working with me for debt elimination. So even sometimes when you see someone with a higher credit score, it's a reflection of their ability to pay things, borrow money and pay things back. It's not a reflection of just how much debt they have access to, right? So your ability. So I've seen some of my clients not be able to get approved for a home. They may have an 850, but they have way too much debt. So it really depends on the person's debt calculation with that 850 credit score. So let's say if you had 5 grand and then you probably only have a $200,000 mortgage on it, then you could move around. I don't know how far and how fast you can move around, but you could definitely have some movement around when it comes to your ratio between cash and credit. As always, I'm always hope that I can at least add one thing that's going to add some value to your purse or wallet. Next week, we're actually going to be talking all about student loans. We're going to talk about student loans, and I'm going to have one of my boss babes, Claudienne Hilbert, who has bought over 20 properties, and we have a very strategic conversation about how you can use real estate investing as a way to pay off your student loan debt. So if you have any questions about student loans, as well as how I can begin to use building my real estate portfolio as a way to knock down some of my debt, you definitely want to tune into that conversation, and you want to be sure to leave any of your questions by way of email or by IG or this comment section. As always, I hope that I've done something to add value to your purse. I'll see you next Monday.